And 3, 2, 1. What's up, Jerry?
All right. It is Labor Day weekend, bro.
Oh my gosh, man. I'm ready. I don't really want the summer to be over, but I kind of do.
I know.
You get old, man. You feel like tired of summer,
I'm not getting
tired
old.
of winter.
What's the matter with you?
I'm getting old. I'm feeling old, man. I don't have my partner in crime down here.
No worries. I'll be back next week.
Woo-hoo,
Give me a couple days. Yeah, right. Exactly.
I'll be walking the Grand Canyon next weekend. You might have to do some.
That might be a good place to be if history in the market continues along the trend. I mean, September is historically a very bad month. Whether or not it turns out to be this year, we'll see. August certainly started off great, but ended with quite the whimper.
Quite the whimper.
But yeah, we shall get into it.
Let's get into it, man.
All right. TSP Weekly Update Show for September 2022. So I had a lot of people asking about fixed income, right? The market has been tanking, or at least in a obvious downtrend since the beginning of the year. So we only have 3 stock funds, a bond fund, and a money market in TSP. Now we have the mutual fund window, but people are asking, particularly people that are either retired or getting ready to retire, is there anything else we can do to kind of get some kind of gains when both the stock funds and the F fund is going down, right? Is the G fund really the only option? Are there things outside of TSP that we can do? So decided to do a show on fixed income, okay? So generally fixed income is bonds, but we're going to kind of get into the definition of that. First thing is going to be this rule of 72, which is probably the coolest thing you're going to learn out of the show. You can take 72 divided by the number of years that you're going to have the fund, and it'll give you the number of years that it takes to double the fund, and it'll give you that rate of return. If you take 72 and divide it by a rate of return, it'll tell you how many years at that rate of return it takes to double your investment. So there's all kinds of different things you can do with this rule of 72. So we're going to take a look at that. And then I bonds, there's been a lot of talk about that on Facebook. I bonds are inflation adjusted. So there are actually 2 components to the rate of return on an I bond, and we'll break that down and see if it's worth looking at as an option. And then double E bonds. So both I bonds and double E bonds are savings bonds. They're not really investing. They're more savings. And then TIPS is Treasury Inflation Protected Securities. Yeah, Treasury Inflation Protected Securities. And then so those are the 3 basically kind of ways that we can play around outside of TSP. And then the bond funds, of course, you can do bond funds within the mutual fund window. So what's the difference between a bond fund that tracks the price of a bond versus the G fund that gives you the yield? So as the yield goes up on a bond, as the yield goes up, our G fund value goes up, but the F fund goes down. So we're going to kind of look at that a little bit. And then the bonus chart is gold, not the metal exactly, but the ETF that goes along with gold. It's ticker symbol GLD. And then we'll look at the TSP fund charts. Okay. So the first part of this, as usual, I suppose, is from Investopedia. Fixed income. So fixed income broadly refers to those types of investment security that pay investors a fixed interest or dividend payment until its maturity date. So it's basically a loan, okay? You're loaning the government or a company your money, and they're going to pay your money back at the end of the maturity date, and you get interest along the way. So at maturity, investors are repaid the principal that they had invested. Government and corporate bonds are the most common types of fixed income products, unlike equities, which is stocks, that pay no cash flow to investors, right? When you buy a share of stock or the CS or I fund, you're just holding that, and you're returns are if the price of the fund for us goes up or the price of the stock goes up, then you make money. If it goes down, you lose money. You're not getting cash flow every month, but on bonds you do. So unlike equities that may pay no cash flows to investors, or variable income securities where payments can change based on some underlying measure, the payments of a fixed income security are known in advance. So when you buy a bond, if it's a 30-year bond, you pay $100 for it. You're going to get your $100 back in 30 years. And along the way, you're going to get X amount in interest every year. Okay. So in addition to purchasing fixed income securities directly, there are several fixed income exchange traded funds and mutual funds available. So we could, if we wanted to, use the mutual fund window to buy fixed income, all kinds of different fixed income assets. Okay, rule of 72. So they didn't really have to have all this in here. It's actually very, very simple. It's a formula used that estimates the number of years required to double the invested money at any given annual rate of return. So it's the annual rate of return, and you're dividing it by 72. So you take 72, divide it by the rate of return that you're expecting, and that'll tell you how many years it takes to double your money, right? Alternatively, it can compute the annual rate of compounded return from an investment given how many years it will take to double the investment. Obviously, there's only 3 variables in there. You guys can just play with the variables. It starts to lose its effectiveness outside of the 6 to 10% range, but it can be applied to anything that increases exponentially, right? So GDP or inflation, you can say if inflation doubles, over 20 years, how long does it take for my investment to get cut in half, for example, right? There's all kinds of ways you can use this rule of 72. But the most common are, how many years does it take to double? You take 72, divide it by your expected rate of return, and that's how many years it takes to double. If you want to know what your expected rate of return is going to be, you take 72 and divide by the number of years that it's going to take to double, which you wouldn't know that. How would you know how many years it's going to take to double? You don't. So you're kind of using it to figure it out, except this does come into play in one of the it's the double E bonds that we're going to take a look at. Okay. So first one, Series I bonds. Okay. There are two. So Series I and Series EE are the two that we're going to look at here. They are the two savings bonds that you can buy from the U.S. Treasury right now. Okay. They're non-marketable. So there's no aftermarket for these two types of bonds. Okay. You buy them, you get the rate of return for them, and if you hold them until maturity, and that's it. There's no market for them. So yeah, the non-marketable feature means they can't be bought or sold in the secondary market. The two types of interest that a Series I bond earns are an interest rate that's fixed for life of the bond. So that's the first one, and an inflation rate that's adjusted every May and November based on changes to the CPI. Okay. So as the consumer price index goes up or down, the rate of return that you get on the I bond goes up and down. So you have the one piece that's fixed for life, the life of the bond. Then you have the other piece that's inflation adjusted. Okay. So that's why they call it the Series I. It's the idea is that the rate of return you get goes up as inflation goes up. And so you're protecting yourself against inflation. Okay. That's the point of a Series I bond. You're protecting yourself, you're protecting your principal against inflation. So the fixed rate component of the Series I bond is determined by the Secretary of Treasury. It's announced every 6 months on the first business day of May and the first business day of November. The fixed rate is then applied to all Series I bonds issued during the next 6 months, and it's compounded semi-annually, does not change throughout the life of the bond. Okay, so they're talking about the fixed rate, right? Right now, that fixed rate is 0. Okay, and it's been 0 for the last couple of years. Obviously, 0 is not a great rate of return, But the reason it's been at zero is because the CPI right now, I think the last CPI print was like 8.6%. But the last time they did the announcement for the bond, it was 9.62. Okay. So if you buy a Series I bond anytime through the end of October 2022, you get an annual 9.62% rate of return. And it pays twice a year. So you get 4.31% interest, 6 months after you buy it. That's pretty awesome in this environment, right? If inflation was all of a sudden to stop going up and reverse and come back down, this number would decrease. But it's only calculated every 6 months. So kind of take that into effect. But it can go all the way back down to zero because the fixed amount is zero. So if we started, it's pretty unlikely, I would say, anytime soon that inflation falls to zero. But that's the idea of the Series I bond, is that it's keeping up with the rate of inflation. Okay. There's some other rules. Taxes. I can't remember what the rules are for bonds. They all have different kind of tax rules. Some of them are taxed federally and state. Some of them are just taxed depending on what state you live in. There's definitely rules. The one big one about the Series I bond is any individual can only buy $10,000 worth of Series I bonds per year. So that's anybody, every individual in your household. So if you have a, family of 5, you don't have to be over 21. Anybody with a Social Security number can buy $10,000 worth of Series I bonds. Okay. So it can be a pretty good deal. It would be a much better deal if the fixed rate was positive, but it's zero. Okay. So the second one is Series EE bonds. Okay. So along with the Series I bond, Series EE bond is one of the 2 types of savings bonds issued by the Treasury. Series EE bonds cannot be sold in the secondary market, right? They're also non-marketable securities. Series EE bonds issued after May 2005 are assigned semi-annual fixed coupon rates on May 1st and November 1st, just like the Series I bonds were. Rates apply to all issuance for the ensuing 6 months. Bonds issued after each date increase in value monthly, but interest payments are handed out semi-annually. So Series EE bonds are considered ultra-safe, low-risk investments. I wouldn't say they're investments. Investments implies that there's risk of gain or loss. And since it's not marketable, I don't know why they use the term investment, because it's a savings mechanism more than an investment. But low-risk investments whose interest is typically exempt from state and local taxes, so that's good. However, they are subject to federal tax, but only in the year in which the bond matures or is redeemed. EE bonds may be purchased U.S. citizens, right, residents, minors. So basically anybody that has a Social Security number can buy either Series I or Series EE bonds. This is really unnecessary. Now, they used to issue actual paper bonds. Okay, they don't do that anymore. Now it's all online. You go to Treasury Direct. I think it's .gov. I don't think it's .com, but it's Treasury Direct, and you can buy bonds directly from the Treasury. The way Series EE bonds work is if you want to buy a $100 bond, okay, you're only paying $50 for that $100 bond. Okay. After 20 years, if you pay $50 for a $100 bond, you get your $100 back. So you just doubled your money. So that's why I said we were going to go back to that rule of 72. So if you say 72 divided by 20, because we know it's going to take 20 years to double, you get an interest rate of return over that 20 years of 3.6%. Okay. In addition to that 3.6%, you're getting that secondary fixed rate of return, which for Series EE bonds is 0.1%. So if you're just comparing the relative value of Series I and Series EE. You'd look at whether or not you thought inflation was going to go up or down, and make your decisions kind of that way. You're pretty much you are guaranteed to get 3.6%. You have to give it to them for 20 years, but you're going to get 3.6% plus that right now, that 0.1%. The only guarantee you get right now on the Series I bond is the annual rate of 9.62, but it's paid out semi-annually and it's reevaluated semi-annually. So if everything stayed the same, you would get 9.62% for the year, which is good. But at some point, inflation will come back down. And if the Fed can get it back down to what it says it wants it to be at 2%, then Series EE bonds will be a better investment because their rate of return at a minimum is 3.6%. Okay. Does that make sense? Colin's asleep. I don't blame him. This fixed income stuff is boring as you can get.
It's not boring.
Oh my God, dude. We're talking about 3.6% versus blah, blah percent. It's as boring as can be.
But people asked for it, right?
If you're retired, if you're retired, you can either watch your TSP dwindle. Hopefully not. Hope you're in the G fund, which, right now, so far, I think year to date, the G fund's like 1.6%, 1.7, something like that. So it's on track to be roughly 2.5% to 3% for the year. And so that's our only option in terms of TSP. But outside of TSP, you can take 10,000 for every member of your family and put it in I bonds. You get some cash flow from that, and you're guaranteed to get your money back. You can get some EE bonds. I mean, there are other options. They're not as sexy as the 25% return in the C fund from 2019.
But that's about balancing your portfolio, right? I mean, that's something that it's outside of the scope of what we normally are going to do with just the TSP, right? We try to focus on TSP because if we get into all the things you can do, it gets really complicated. And that is where a financial advisor is helpful. The problem, and I think I told you earlier today, I had lunch with one of our buddies. Big shout out to Al. He's retiring and going down to South Carolina. But
congrats, Al.
We're talking about these things, and it's once the gloves are off and you're retired from the government or the military, if you can find a financial advisor to give you the time of day, that's the tough part because some of us have enough assets that we can get someone to listen to us, but it's not always the case, right? And so, that's one of the reasons why we do what we do. But anyway, back to the point of, these bonds and this kind of fixed income, options. These are things that you guys, if you're retired or getting close to retired, should start educating yourself about, because what this is about is balancing your whole portfolio. So, bonds really low risk, right? That's why there's low return. That's how it works, right? Yeah. But it's a place you can park, a portion of your portfolio and sleep well at night. And a portion of your portfolio, you might want to be more active with, right? And so I think all this stuff is interesting. I was just being quiet because I didn't want to talk over you.
All right. Well, I got one more. I think it's only one more. 2 more slides about tips before we get into the TSP stock funds. Yeah, tips. So the principal value of tips. So the idea is much like Series I bonds. The idea is that tips protects you as inflation goes up. Okay, inflation is the pace at which prices increase throughout the U.S. economy, as measured by the Consumer Price Index. Inflation becomes an issue when there isn't commensurate rise in real wage growth to offset the negative effects of rising prices. An awfully complicated way to say that prices go up and your salary doesn't. Tips are a popular asset for both protecting portfolios from inflation as well as profiting from it, because they pay interest, like bonds. They pay interest every 6 months on a fixed rate determined at the bond's auction. However, the interest rate payment amounts can vary since the rate is applied at the adjusted principal or value of the bond. So If the principal amount is adjusted higher over time due to rising prices, the interest rate is multiplied by the increased principal amount. Okay. So that's how you can gain with tips. That's how you make money with tips, is that as the rate goes up, it's adding to your principal and you're multiplying the rate by a bigger number. Okay. So as a result, investors receive higher interest or coupon payments as inflation rises. Conversely, investors will receive lower interest payment if deflation occurs. So you have to pay attention, right? You can't just buy tips and let it roll. You wouldn't buy and hold tips, right? You're buying them for a reason, and when inflation starts coming back down, you don't want to be in them. So tips are issued with maturities of 5, 10, and 30 years. They're considered low-risk investments because the government backs them. At maturity, tips return the adjusted principal, right? Because we said the principal can adjust up and down, or the original principal, whichever is greater, right? So you're not going to lose your principal, okay? Even if the principal adjusts down, it adjusts down, and that will affect the interest rate, the cash flow that you get as the fund goes to maturity, right? So if deflation happens, you'll get less cash flow every month, and the principal will in fact be lower. But if you hold it to maturity, you're going to get all your money back. Okay. So suppose an investor owns $1,000 in tips at the end of the year with a coupon rate of 1%. There's no inflation as measured by CPI. The investor receives a $10 coupon for that year, right? Because the interest rate was 1%. He invested $1,000. So 1% of that is $10. If inflation rises to 2%, the $1,000 principal gets adjusted upward by 2%, right? So now the principal is $1,020. So the coupon rate remains the same at 1%, but it's multiplied by the bigger number, right? It's multiplied by 1,020. So then the next year, the payment is $10.20. So that's how you're making money in tips. Okay. Not a bad way to do it. It's a little bit more complicated than just a straight up bond, but tips can definitely be, if inflation goes up and you have enough money in there, tips can be pretty good. And really it depends on obviously what the coupon rate is. Because if it's 1% and you only have $1,000, to make 20 cents isn't super helpful. All right. So bond funds. So if we just go back to TSP, we have the F fund and we have a whole bunch of different bond funds that we can do in the mutual fund window, right? So for many investors, a bond fund is a more efficient way of investing in bonds than buying the individual securities, right? So if you wanted to buy bonds in the TSP, the only way you can do it is through the F fund, which is it's the aggregate bond fund. It's a pretty good bond fund. It's sort of all inclusive, kind of like the C fund. Bond mutual funds are just like stock mutual funds in that you put your money in a pool with other investors, and a professional invests that pool of money according to what he or she thinks are the best opportunities at the time. Some bond funds aim to mimic the broad market, investing in short and long-term bonds from a variety of issuers. Could be government bonds, government agency corporations. Other bonds focus on a narrow slice of the bond market. Can be short-term treasuries, junk bonds, high-yield bonds, whatever. Whether the fund's mandate is broad or narrow, bond funds invest in many different securities, right? Securities means products. It doesn't mean stocks, because it's obviously it's a bond fund. They're investing in bonds, often buying and selling according to market conditions and rarely holding bonds until maturity. Okay. That's kind of an important piece, because some of these bonds, if you don't hold them until maturity, you're not getting the full value that you invested in the first place back, like in tips, right? We said tips, if the inflation goes down, it'll eat into your principal. But if you hold it till maturity, you get your whole principal back. But if you have it in a bond fund with a fund manager and they sell those bonds and you don't hold it to maturity, you're not getting your full principal back. That's why the price, when you look at a stock chart of the F fund, you're looking at a chart of the F fund, it goes up and down. So it's an easier way to achieve diversification, even with a small investment. Income payments are made monthly and reflect the mix of all different bonds in the fund and the payment schedule of each. As such, the distribution may vary from month to month. So this is significant in terms of if you wanted to buy bond funds in the mutual fund window, you would get you could, depending on the bond fund you bought, you could get monthly cash flow, monthly dividends from bond funds that you buy in the mutual fund window. You do not get them from the F fund. Okay, the F fund, even though it's a bond fund, it doesn't give you, it doesn't have a payment schedule. Okay, it doesn't do dividends. So arguably it could be, I'd have to actually look at this and try it for a while, but you could do a aggregate bond mutual fund to try to replicate the F fund in the mutual fund window and get actual distributions month to month. So it would be interesting to see if it was more valuable to, if you're going to put 25% in the F fund, let's say, if you took that 25%, bought a fund in the mutual fund window that mimics it, but that does give you distributions. So I am going to take a look at that. All mutual funds have operating expenses that include the cost of managing the fund. You get sales charges, loads, no loads, like it, and that all eats into your rate of return. Some funds charge a redemption fee for shares sold within a certain period of time, right? That's a big thing for bond funds. Others may charge a small annual account fee. Make sure you are aware of all expenses before you invest. That's specifically talking about the mutual fund window. Most bonds pay regular monthly income, although the amount may vary with market conditions. Again, I just put that down there to remind myself to talk about it. This is talking about the mutual fund window. It's not the F fund. So this feature can make bond funds an appropriate choice for investors who desire somewhat stable, regular income. If you do not wish to receive the monthly income, you can choose to have your dividends reinvested automatically as one of several dividend options. So you don't have to take the monthly payments. You can roll them back into the fund. Okay. All right. Y'all can wake up now because that's it for fixed income. All right. Gold. So there has been, along with fixed income, when you talk to people in that talk about fixed income, the very next thing that people want to talk about is gold, right? If inflation is going up, gold is supposed to be a hedge against inflation. That's what everybody believes to be true. It is as true as gravity, except it hasn't happened. Since, the top back. So I'll say that the top in gold back here was just before the top in the NASDAQ or the S fund. So gold actually topped out first. And then it came down, it came back up, got a little bit higher, and it's come down quite a bit in 21 and so far in 2022. There's an argument to be made that, even at this point, gold has held up better than the G fund or the S fund or the C fund, but we expected gold to be doing like this when inflation is doing that, right? And clearly that's not what we're seeing. Okay. So if you watch anybody on YouTube, there are plenty of, they call them gold bugs, plenty of people out there they are convinced that any day now gold is going to explode higher. And just because of all these fundamental reasons why gold is it's always for the last 5,000 years been a hedge against inflation and all this kind of stuff. The bottom line is we're going back here to 2005. It's a monthly chart. Okay. When gold is above, this is a 20-month moving average. Okay. Because we're looking at a monthly chart. It's a 20-period moving average. The period is a month. So this is a 20-month moving average. When gold is above that 20-month moving average line, you want to be in it. When it breaks down through that, that 20-month moving average line, you don't want to be in it, right? And the most interesting thing about this chart is this. Right, we are here. Okay, we've got 2 consecutive months. This is as of the end of August, right? As of August 31st. So we've got 2 consecutive months below that 20-month moving average line. And we had this, what is this? 2.5 year consolidation so far, right? It looks very similar to this one. Okay. So I just find it ironic that we did this double top. It's basically a double top, now a triple top, right? And the consolidation looks a lot like this one. And somehow there are people out there that are absolutely convinced that gold goes higher from here. I don't know that it's gonna do this, but it looks exactly the same as this. So I don't know. Price is the only thing that matters. If you believe that gold is going higher, you can believe it all day. But if it goes down, it goes down. Relative strength on a monthly basis, which is a long term, it's below 50. RSI had turned, or MACD had turned negative a while ago, back at the beginning of 2021, and is expanding to the downside. So I wouldn't own gold right now. As much as I would like it to be a hedge against inflation, the price clearly is telling us it is not. Okay, that's gold. All right, TSP fund charts. So we're back to the weekly, right? So the blue line is a 20-week moving average line. As long as we are above the 20-week moving average line, the C fund is moving higher. In January of 2022, it broke down big time below that line. It was the first time that it broke below that line since this collapse from COVID, right? So this was a big, huge red flag. Okay. It was the first indication that something had changed. It wasn't a confirmed trend change at that time, but it was a huge red flag. The confirmed trend change happened when we couldn't get back above that line on a closing basis, right? We couldn't close back above it. And then we went down, put in a low, came up, couldn't get back above it, put in a lower low, came up, got a little bit above it, roll back over, test, roll back over. So where we are right now, right? We've been above it. We were above it for 2 months. And then in the last 3 months, we've rolled over pretty hard. Or 3 weeks, sorry, rolled over pretty hard. So RSI below 50, MACD hasn't crossed over yet on a weekly basis, but it does not look good. Histogram is definitely pointed down. And as long as price on a weekly basis is below that 20-week moving average line, you don't want to be in the C fund. S fund, basically the same thing. We're closing in on the prior low in June. This is going to end up being a 1, 2, 3, 4, 5 of some sort. There's going to be some sort of Elliott wave count in here. And for a 1, this is going to be a 2. And then there's going to be some kind of move like that for a 3, a 4, and a 5. That's, nothing's guaranteed, but that's kind of the way the stuff works. So I wish I had some better news, but it's just the way the stuff works. If and when we get below this June low, the next target that everybody's going to be looking at is the COVID low. Okay. I fund, same kind of thing. Everybody knows that Europe is in much worse position financially, economically than the US is. And so the I fund is already, as of the close, we did this on September 1st. So what is this, Thursday? So as of the close on Thursday, we've already closed on a closing basis. We are lower than this low. And you can see that it's reflected in RSI, which is lower than the C fund or the S fund. And the MACD is just about to cross negative on a weekly basis. So nothing good to talk about on the I fund. F fund, same kind of thing. This basically is a factor of the market finally believing that the Fed is going to raise rates. This is our bond fund, right? So as rates go up, price goes down. Okay, as yield increases, the price of the fund goes down. And on our F fund, we don't get yield, right? We don't get yield as a rate of return. We only get the gains or losses in the price of the fund. And so, you know, any week now, we're going to be testing that prior low. RSI way below 50. And the interesting thing here is that even though we got above that 20-week moving average line, we never got above 50 on the RSI. We crossed positive in MACD, but that relative strength is really, really important. It's very telling. If you can't get above 50, it's a bear market rally, which is what this was. And speaking of bear market rallies, that is the topic of the webinar that we're going to do in June or September 6th, 5 p.m. East Coast time. I talk about it every Wednesday on the Facebook Live. So if you guys haven't signed up for that, definitely sign up for it. We're going to talk about historical bear market rallies and what happens, why they happen, and what generally happens after a major bear market rally. All right.
Questions.
That is all I got.
That's a lot, bro.
It is, right? It was pretty good, I thought.
Yeah, you put a lot in there in a short amount of time.
Yep.
So if you guys have questions, please put them in the comment section wherever you find the video, whether it's on YouTube, Facebook, MySpace, whatever.
MySpace? We still got that?
MySpace? No, we don't. If you don't find a comment section to put a question in, you can always send us an email at support@growmytsp.com. Hope you guys are having a great holiday weekend. This is pretty much the end of summer for most people, so there's a lot of traveling going on. And we will have Jerry back in the studio, I think, for our next show. We'll see.
Next week.
Yeah.
I think next weekend.
We'll be live together.
We will be, yeah, next weekend we will be live.
Yeah. Yep. All right. All right, guys.
The other thing, the members only webinar is going to have to happen next, probably the week after, not next week, but the week after, not this week, not the first week of September, probably second week of September. And the members only, or the public webinar, like we said, on September 6th. And I thought there was something else I was going to mention, but it slipped my mind.
You're not getting old, man.
Who?
All right, guys. If you liked the show, make sure you share it with your friends. If you don't like it, share it with friends anyway. Hope you guys have a great week, and we will see you. We are out of here.
Later.